Hello, trading friends, and welcome back to Forex Focus, brought to you by IG, getting you ready for non-farm payrolls to come out here in March, letting you know what the scene was on the U.S. labor market for the last month. We'll define exactly what non-farm payrolls are for you. Take a look at the expectation for the March number, expected around 200,000. And give you some context for what that could mean for interest rate markets, currency markets, as well as stocks and some commodities like gold. But first things first, what the heck is non-farm payrolls? An interesting term that is essentially just the biggest employment statistic that comes out of the U.S. on a monthly basis. And it essentially lets you know by how many jobs the U.S. labor market grew or fell. And it also highlights what sectors in particular saw a lot of job gains or declines. And as you might imagine, given the name, these are all jobs outside of agriculture. And this was developed when agricultural employment and that part of the economy was a much larger piece, whereas now non-farm payrolls is really the majority of employment in the U.S. And so it on a monthly basis lets you know essentially how the employment part of the economy is going, similar to how your CPI inflation lets you know how the inflation part of the economy. And if you've studied economics at any level and learned about how the monetary policy works for major economies and how central banks work, you'll remember that employment statistics and inflation statistics are really the two main pieces that a central bank thinks about when they're setting policy. And so this is going to be really meaningful for the interest rate market at the kind of top tier item coming out of a number like this, but also the currency market, the equity market, the commodities market as well. We'll get to that in a second. But you might also think of this as the unemployment rate, right? And these numbers come out in tandem. And as you could imagine, for all else equal, a relatively high non-farm payrolls number would tend to line up with a low unemployment number. If the population and everything is staying the same, but more people are getting jobs, the unemployment rate would likely fall. But as you can see, this number has been, it can be very important depending on the context and the environment. It's been very boring recently because it's been right in there. You see the last six readings has been either 3.7 or 3.8%. And the big whopping deviations from this were a 3.5 or 3.4% reading. And so the actual payrolls number and how it deviates from expectations has really been the important piece. And again, like I say, this stuff can change all the time. The most important metrics changes all the time. But for right now, the non-farm payrolls has really been the headline, and which will make sense because let's take a look at the last couple in particular. And you see some, first of all, big deviations, right? Over the course of the last six readings, it's not a matter of, 180 and 190 and 200,000 jobs. Similar to that unemployment rate barely changing on a month-to-month basis. You have readings that are going from 165, 182, all the way up north of 300, the most recent north of 350,000 jobs. And the expectation for the last 2 months has been 170 and 180 respectively. And so blowing out these expectations, absolute unbelievable numbers in here, and this has really shaken up markets. It's no coincidence that in the same time, you've heard talk about how the Fed is maybe not cutting rates until later on in the year because the employment is still hot and inflation is still, it's not necessarily moving higher, but it's hotter than the central bank here in the U.S., the Fed, wants it. And this employment, like I said, employment and inflation usually working in tandem a lot of times, and can also be the two top things that the central bank are usually monitoring. And so let's take a look at the last two dates here, the last two non-farms, where you saw the big beat expectations, the much higher than expected number. And it's, of course, no coincidence that these are two of the big days in terms of intraday range for the dollar yen, for example. And also, I don't think it a coincidence as well that after these numbers came out that were both stronger than expected, one, you saw some upside in that day, but also an ode to market doesn't have to do anything necessarily. That number that came in January there, the first data point, it reversed a lot of those gains. But you did see a strong dollar in the days and weeks following this strong data in the U.S. And again, I build on that to say that among these strong employment numbers is when Fed Chair Powell and the U.S. Fed in general started to move out their expectations. There was an expectation that the Fed might cut much earlier here in 2024, and those expectations have moved out as employment numbers and inflation numbers have been a little hotter than expected. But yeah, some big moves around these numbers. Now, there's no guarantee that, if the number comes in high, the dollar has to go higher. But there's the theoretical example of strong U.S. data, interest rates in the U.S. staying strong, and that dollar maybe seeing some strength as well. Doesn't have to play out that way, but what we have seen that is likely is some volatility, some movement in the market around this jobs data. And I also want to take a look at interest rates because, again, this is the first tier, so to speak, because if there's big changes in employment data or inflation data, and that means that the central bank needs to either cut or hike or hold or whatever, that's primarily going to affect interest rates, right? That's what they're cutting or hiking or holding. And you see here, off of this number was the bounce back in the 10-year there, the last reading, the first week of February. And then the follow-up there throughout most of February was the 10-year yield got back to almost 4.4%, and it's been falling a little bit in recent trading. And so, again, this non-farm likely to move markets around. The expectation going into the March non-farm is 200,000 jobs. If that comes in only at 100 or 150,000, then maybe that does lead to U.S. interest rates and U.S. dollars moving lower on the idea that the economy isn't moving that fast anymore, and the Fed can finally normalize and cut interest rates, normalize them lower. If it comes in at 250 or 300,000, you might see what you saw the last time, which was a rise in interest rates, rise in U.S. dollar, and a pushing out of Fed rate cuts in time. Anything, of course, on the table. If it comes in line, who knows what's going to happen here? Could be taken as a bullish or bearish number for these markets. And then also, stocks and gold have been relatively uncorrelated in recent trade to interest rates and forex. But they do tend to see big moves around these data points, historically speaking. So we'll be monitoring all of it. Again, 200K is the expectation number coming up on Friday morning. Thanks for watching, everybody.